Good afternoon. As we get started here, I'm going to give it just a minute more to let people get in. All right, as we get started, thank you for joining us today for our discussion regarding private equity. I appreciate everyone being here. For those of you that are at all interested, feel free on the Q&A box if you want in your ribbon. If you need to ask questions, feel free to do so. I hopefully can answer them, and if I have to take it offline to answer anything too specific, I certainly can do that. Today, we're going to talk about private equity investing and what it is, who is it for, that kind of stuff. And we always like to start with a little introduction from the attorneys because they want to make sure that we warn everyone that if you do want to think about this kind of stuff, please make sure you consult with your advisors because at the end of the day, some of this stuff has different risk involved. So please reach out and talk to people. Don't take anything I say as direct advice today. And with that, I'm going to get started. Uh, for those of you that may not know me, I am Jon Meyer. I head up the wealth management side of BGM, and BGM is made up of many different things. I always remind people outside of wealth, we also have the trust side, a CPA side, an M&A side. There's all kinds of things that if you are interested and need help, we can hopefully be there for you. And with that, let's jump into today's agenda. From our standpoint, I want to talk first about what is private equity. Um, and why it might fit into certain portfolios and where and how kind of thing. And at the end, I'll jump into, if you're at all interested, how BGM can help in that process. What I'll start out by saying, though, is for the most part, what we're talking about typically is for portfolios with 5 million and above. I say that because this is not something that is generally something that takes or something that should be just slid into a portfolio because it isn't fully liquid. So that's what we'll get into today, but I just want to bring that up at the beginning. With that, let's jump into what is private equity. Private equity is basically a little different than public, and the main things that you want to point to is that the ownership of private equity is concentrated in a few people or a few groups of people, whereas public ownership is very broad and typically going to be typically thousands of people or even more than that. That's why in the private equity side, information is just slightly less available to some degree. Everything's a little more quiet. If you think about any private company, the answer is that the information is a little harder to get to. To that extent, the biggest things that people talk about as the pros and cons are that the liquidity of a private equity fund or direct investment in a company where it's private is an issue. You don't have quick liquidity. If you want to get out, it may take 10 years to get out. And so I always bring that up as one of the warning things. The second side to that, though, that's the positive is behaviorally, I like that liquidity issue is there because if people can't get out, they actually stop paying attention to the constant price question of whether or not an investment is going up or down. When you're investing in the stock market, people tend to um, focus on what the markets are doing every day. And in private equity, we see the exact opposite because things get repriced typically on a quarterly basis. And so most people just kind of set it and forget it a little bit. And I think that behaviorally is actually a good answer. So I bring all that up because private is different than public. Now, people will say to me, why should I think about private? And here's the reasoning behind it. Basically, in the US, we're down to under 5,000 companies that are actually listed on the public exchanges. If you think about it, everyone thinks the New York Stock Exchange or the S&P 500 or the Russell 2000 has all these companies, but we're down to very, in my opinion, few companies to invest in to some degree. And that's happened over the last decade or two, where for some degree, companies could get funding from private investors, especially private equity funds. And so they didn't need to go public anymore to get capital. And that's part of what's changed it. And so as companies have sold or merged or whatever, the new companies aren't coming on board with new IPOs as much. Um, to that extent, right now there are more than 215,000 companies in the US that are seeing revenues of greater than $10 million. And so there's a lot of companies out there, whether they're small or larger. And to that extent, the opportunity to invest in something different that might have some possibility for higher return is interesting to some people. So when we look at private markets, we want to think about different pieces of the puzzle that we need to be considerate of. And we always talk about this as risks. I think, yes, there's risks, but I also think there's sort of things that about this, like I already mentioned, with behavior that can work to your advantage. The things that people dislike the most, though, I'll tell you, is that when you invest in private equity, you do have to wait for K1s to come out. And so almost everyone that invests in private equity will not file their tax return on time. You will extend and file it in October. And if you don't like that answer, this is not for you. So administratively, this can be some extra work. The other parts of it, though, that people sometimes don't always love is that they're not going to get constant update on valuation. That can change. And it's up to the private equity fund you're working with to set those valuations. So there is a little bit of that questioning sometimes, is this really worth what they say it's worth or whatever? The illiquidity is an issue. And so there is some of those kinds of things. And then lastly, I'll point this out as a bigger deal maybe. There isn't as much regulatory oversight in private companies. And so some people, when they invest, they like the fact that the SEC and everyone is watching things. Well, in private companies, that's not happening. And so with that lack of regulation, some people like regulation, some people don't. But when it comes to investing, you just have to be aware that that lack of regulation can mean that, quite honestly, you as the investor has to do more due diligence to make sure that you know what's going on. So let's jump into why investors actually consider private equity. The first thing that I'll point out, and this is always the big one, is that private equity by rule, I think people would say you invest in private equity because you think you're going to get higher returns. Now, these are returns that are basically as of June of 2022. And here's the other problem with private equity. When you're trying to look at things like this, where you say, what's the return of a private equity investment? The information comes in slowly, and we're looking back a few years still to figure out like what's gone on. But in general, you would expect that compared to the S&P 500 or the Russell 3000, you're going to see private equity investing doing better. That's what you would hope. There's no guarantee of that, but that's what you would hope. That's the reason to do private equity. If you're going to get locked up for a long period of time, that's what you want. So from that perspective, that's the biggest thing. And what I would point to as the opportunity here is that the value add that private equity can bring to a company is the issue. So many companies grow to a certain level, and to go from that level to the next big level is going to take a lot more resources, whether it's human resources and skill, whether it's just capital they need to add something, add a new machine or buy out other, competitors or whatever it is. It's that value add that private equity brings that is what unlocks the potential and hopefully gets you those higher returns. That's really why private equity might make sense as an investment. Now, let's talk about the types of private equity out there. When I talk about private equity, I really am referring to several things because private equity, if we think about it from a stock market perspective, the stock side of things could include anything from venture capital all the way down to distressed equity, you know. But the other side to that is bonds, right? So we always have to go over to this other side of private debt. Now, private debt, if you're paying attention at all, has been written about in the market in the last year or two as something to be a little concerned about because there's been one or two minor issues. But in general, private debt is simply companies that want to borrow from private investors instead of their bank. And if, in fact, oftentimes banks may not give them the deals they want, and so they might go to private investors to borrow, and that's where we get into private debt. And then you have private real assets, which is typically going to be private real estate. Could be other stuff, but for the most part, it's private real estate. And again, you're looking at different ways to capitalize and do projects, things that maybe banks might not like, um, or they're trying to do something just unique. So today, I'm not going to differentiate between equity, debt, or real estate. Just know that privates in general incorporate all this different stuff. I'll use the term for the rest of the day of private equity, but it couldn't include any of these things. To that extent, the spectrum of private equity is really anything from venture capital all the way up to this distressed special situations. If you think about the life cycle of a company, it starts out small, then it grows, then they might try to do some leverage buyout because it's a mature enterprise, and then all of a sudden something goes wrong, or they need to do something different, and now you're in that distressed or special situations category where you're trying to recapitalize the company to grow to the next step. This is the continuum of where you can invest. And some people like to invest on the startup side of things. Some people like to find problems on the back end. Some people like to be in the middle where they're just like, no, I want a company that's, in a good spot. It just, some of it depends on what you want from the return perspective too, because certain areas might have higher or lower returns. To that extent, I don't throw this slide up to make your life miserable. What I want you to see in this slide is that there are so many things to consider when you look at doing due diligence on private equity and where it sits in that investment cycle that you really need to pay attention. This is not like just saying, I want to invest in the top five, tech stocks in the stock market. Like for the most part, a lot of the information is going to be known in the marketplace. And as an investor, maybe you feel like I can invest in one of these big companies in general because the rest of the world's investing in them. When you get into private equity, it's a different animal because there's fewer investors, the information is limited. And so I bring all this up so that you understand that there's a lot of things to pay attention to. I'm not trying to scare anyone. I just want you to be aware of how much effort this can take. So to that extent, let's keep moving. Let's talk about the structures of private equity because how you get into private equity is a different animal as well. You can do it this way just by buying a company. So you go in and think of it as a buddy down the street says, hey, I'm going to start a new manufacturing firm and I'm going to create some kind of manufactured steel product and I want you to invest in it and hopefully I make a ton of money. That's perfectly legit. You could just go direct into one company. Where private equity tends to happen, though, is it tends to be more in a private equity fund, and so that's this gray area. And what that is a private equity manager will raise money from investors and then go out and buy individual companies. And so the private equity fund may have a mandate towards one specific thing. So in today's world, maybe, for example, the easiest example might be an AI fund that they're going out and finding different AI companies to invest in. Typically, these private equity funds will be fairly concentrated. And so you want to make sure you understand what the mandate is. because they may be very much in just one little niche. A secondary fund is basically this idea that there could be a private equity fund out there that basically doesn't want to be in business anymore, needs some liquidity because they've been around forever. Maybe there was a death of the fund manager. Who knows why? These private equity funds might get to a point though where they want to get out a little bit. And so what happens is they sell their interests, which is this piece, to a secondary fund, and the secondary fund basically trades at a discount to the market. And now you can buy into something where you might have a bunch of different private equity funds inside of it in the secondary fund structure. And so you have access to something that maybe you couldn't get access to. Maybe you didn't have money 5 years ago when the private equity fund first started, but now you can get access to a secondary fund or whatever. This is just a different way to go about it. And then finally, the fund of funds approach. And the fund of funds approach is where we basically take this private equity fund idea, and now the fund of funds might go out and say, we're going to have 5 or 6 or 10 different private equity funds inside of it. And they're going to be of different styles. So one could be dealing with distressed debt, and another one could be dealing with infrastructure, and a third could be AI, and a fourth could be, just name your issues. In this way, they can kind of mix and match the fund managers to create a fund of funds that is more balanced, maybe takes away a little risk, maybe gives you some opportunities you wouldn't get elsewhere, that kind of thing. This tends to be the spot where we tell most clients, if you're going to invest in private equity, this is probably the way to do it at the get-go. Just easier to get in. It's going to be something that's generally a little bit more balanced from a risk perspective, but it's also an easier way to do it. They then will roll up all these different private equity funds into this fund of funds, and the fund of funds will issue 1K1. It just, everything about it's just a little bit simpler. Now you do pay fees. There's fees on the funds. And I'm not going to get too far down the road on this, but on the downside of any kind of investment in private equity, you tend to pay higher fees than you would in the typical stock market, of course. And you also typically have some kind of carried interest, they call it, where the fund managers basically get to keep some of the profits. And so it's a different animal than if you invest in the stock market. To that extent, I've laid out for you some of the different options here and why one approach is better than the next. There's a kind of a pros and cons. That layer of fees, though, is a bigger one than not to focus in on, because again, depending on what you're doing, these fees can sometimes be 2, 3, 4 times higher or more than if you're just investing in the typical stock market. But to that approach, this fund of funds is the way that we typically see it. Other ways we see it is this core and satellite, where you kind of do a core, where the core, quite honestly, could be a fund of funds, by the way. And then the satellite is, and you have some understanding of something very specific. Like I'm in the AI space, I know AI, so I do a core, but then I'm going to add a satellite of just this one manager in AI because I know that space and I think he's going to do it. That's another way to do it, where you spread your risk a little bit, but the satellite should give you a way to juice returns a little bit. Focus direct is where you basically go out to individual funds and just buy them directly. I would argue in this scenario, if you do that, you're going to need a lot more volume, though. So I wouldn't necessarily go out and do that with just $5 million. And then finally, the opportunistic are where you have very high conviction ideas. And so again, I tend to say in this space, it's because you really know something. Shouldn't dabble in this space at all. If you think about it from the standpoint of return potential versus burden/risk, the fund of funds approach, the return potential is probably lower. Again, we're assuming in these scenarios that the return potential is higher than the S&P 500. But for the most part, in relation to each other, the fund of funds approach is probably the most simple, therefore the return potential is the lowest. And as you go up that scale, you see where the return potential jumps. But the operational side of this, the administrative hassle, all that stuff gets bigger. And so a lot of people just don't like to go out on these ends. Now, I'll just throw this up there because this is how we are working. Basically, what we do is we work, and this is just slight commercial on our end, but we work with Fiducient Advisors. Fiducient is a firm out of Chicago that would help build the fund of funds approach. And so I bring it up just because we do work with an outside provider. We don't do it internally directly because of the expertise you need to actually go vet all these issues. So I do bring that up as something to be aware of if you ever want to talk to BGM. But if you're just talking to anyone in the world about this, it's always good to understand where they get their data because it is a different animal. Now, as I keep moving, I am moving fairly quickly because I do think that this is a complex topic that we could spend a lot of time on, but I also want to keep it kind of high level. And here is a high level idea within how to invest in private equity. We call this the pacing model. And the way I want to explain this is to start with an example. Because this is how you should think about investing in private equity. And let me start this way. When people invest in private equity, they do this from the standpoint of saying, I want a percentage of my portfolio to do it. And then I'm just going to buy that percentage in private equity. Unlike investing in the stock market, that actually is not the best way to do this. And so what I want to do is walk through a model of how to get into private equity that's more similar to how you invest in a 401k plan, where you dribble money in over long periods of time. Just like in a 401k plan, if you're still working or if you remember that, you put money in every 2 weeks. I'm not suggesting you do that every 2 weeks with private equity, but every year for a decade or more is what I'm going to suggest. So let's talk through this. Let's pretend you have a portfolio of $5 million. Let's pretend that portfolio is growing at least by 3% a year, just net, meaning net of taxes, fees, inflation, that kind of stuff. And let's say in that portfolio, you want to put 10% of your money, or if you think about it, $500,000, because 10% of 5 million is 500,000 into private equity. Here's what's counterintuitive to this. We actually then, if we saw these parameters, would say we would recommend investing 200,000 a year into private equity. And you're saying, well, why would I do that? Whoops, I just bumped something. Why would I do that when I want to put 500,000 total in? Why would I do $200,000 a year? So let me get to that. But that's where I'm going to suggest we would go. And the reason for that is because over time, the target allocation will actually get to the 507 years. And let me talk about why that is. Basically, when you invest in a private equity fund, you have what we call the J curve. And the J curve is simply we commit capital. And let's say I'm saying that I want to commit 200,000 a year. While that capital is committed to the fund, the answer is that the fund doesn't need the money all up front. And so what we do is we say, here, take our money. And the fund says, we'll call you when we need it. So then they randomly reach out throughout the year and say, send us 20 grand, send us 42,000, send us weird numbers. And the reason they do that is they don't take your money until they actually have an investment that they're going to make in a company and they need your money. So even though you've committed to it and you've contractually committed to it, they won't call all your money and it may take many years. And so what this J curve shows is that it could take literally 5, 6, 7 years to invest all your money. Okay, so they call your capital, that's the dark blue, And as they call your capital, you don't really start making too much money on it. But let's say the light blue, which is the upside here, is where, well, let's say they make an investment that suddenly they sell fast and make a little bit of profit. So the upside here is they could start seeing some profits, usually in year 3, maybe as year 4, they start seeing some profits, but the profits really start to come later on. And so it takes a while to commit all that capital. And then those companies that they invest in takes 3, 5, 6, 7 years sometimes before they start selling them. And so now you've got this idea that somewhere down here is where you start making the money. That's why we call this a J curve. If you think of the letter J, early on, you're not going to see a lot. And then as you start to make money, all of a sudden it starts rolling out. Now let's apply that principle to what I said earlier. If I want to put 10% of 500 or 5 million in, that's 500,000. I commit 200,000 a year. And here's why. 200,000, what they actually call might be in year 1, $23,000. Okay. They distribute back to me pennies, whatever that is. And so I'm invested 23,000. So after year 1, I've got 23,000 actually invested, which is 0.5% of what I said I would do. And if you follow this math, it literally takes until 7 years out before I'm roughly 10% allocated. And you'd say, well, I only wanted to invest 500,000, but in 7 years, I got 600,000 in. That's because the portfolio, if you remember, I said it was growing at 3% a year. And so as the portfolio grows, 10% of a growing number is some different number than 500. But in general, what you see is the committed capital is what we focus in on. And it takes a lot of years before we see the committed capital even get close to the quote unquote $200,000 number. But if you think about it, what's going to happen as the portfolio grows is you're going to basically get to a point where you don't necessarily have to put more in as much. And in fact, by year 8 or 9, somewhere out here, there's enough distributions coming off the portfolio that it actually covers the amount of capital that they keep calling if you keep doing this. And so in general, it starts to turn positive for you that way. And so you stop putting your own capital in and you start using the profits to put capital in. What I'm suggesting here is that this is an ongoing forever kind of thing. This isn't, I'll do it once and see what happens. And the reason it's not, I'll do it once and I'll see what happens is because when you do it once, you're basically saying that that year is the year that's going to have all the profits and you don't think any other year will around it. And that's where you get in trouble. So what we try to do is we call each year a vintage. We try to do different vintages, and that's why we commit each year so that we have different vintages, because one year might be hot, the next year might be cold. You don't know. It just depends on the type of companies that they invest in. If you got, for example, today we're talking about AI, but you know where people are making the most money in AI? It's the people back in 2023, probably, that put money into some of these funds and got in on the floor of some of these AI companies. And today they're going to see some of that come to fruition when these companies go IPO. So it takes time, and that's why we say put money in over time, and you'll hopefully see that J curve work to your advantage over time. Now, a caveat to this, and I always bring this up, is you could run into a scenario where the portfolio drifts because the portfolio actually declines in value. So that can happen. And here's what happens when you're in this scenario over to the right here, if your portfolio declines 20% in value. And when I say portfolio, I mean your entire portfolio. This is the stock market, public stock market included in this. If your portfolio were to decline, basically what happens is the allocation to private equity is increasing as a percentage of your portfolio because you've got assets dropping over here, but you're committed to all this capital over here that you have to put into the private equity because you contractually said you would. And so what happens is you could get overweight from that 10% allocation over time if the portfolio were to decline in value. I just bring it up so that people think through this and are aware of what's comfortable. Um, I also bring this up because I'm suggesting 10% of a portfolio. You will hear um, people in the marketplace suggest that portfolio should have 30% of the portfolio on private equity. Well, what I'll tell you is even at 10%, if the portfolio drops in value, you might start inching up to those numbers quicker than you think. So be careful about what you are willing to commit to on the front end because over time things change. So just a heads up as to how to think about what happens in down markets, not just up markets. I'm going to close it out because this is a nice, easy half-hour presentation. If you have questions, now's the time to throw them in. If you want help, we can help you. We do have access to the private markets, and we're glad to help. So feel free to reach out if you want to talk further about it. For our clients who are interested in it, we're happy to even put together some modeling to show you how it might work. So that's not a problem. I also want to point out for those of you that are interested, I do have a podcast that is called Mastering the 360 Mindset. You can find it on Apple and Spotify, so feel free to check. And the whole point is to talk about the intersection of health, wealth, and time. Um, and so there's interesting things. Our most recent one that got updated, that got uploaded yesterday, is actually interviewing someone here about private or about mergers and acquisitions and how companies sell. But there's all kinds of fun topics on there. So I would encourage you to listen to that. Coming in July, we have an economic update, so feel free to watch for that. And that will be an economic update more on private or public markets as well as our economy. But I encourage you to attend. All right, seeing no questions, I am going to then call it for the day. I thank everyone for joining us and feel free to reach out if you have further questions. Thank you, everyone.